Let's be honest, nobody teaches us how to build real wealth. It's not in the school curriculum, and most of us only figure it out after making some brutally expensive mistakes. Maybe you feel like you're doing fine right now. Bills are paid, you can grab drinks with friends, maybe even take a vacation here and there, but what about the big stuff? Buying a house, sending kids to college, actually retiring without living on instant noodles? Even if those worries feel far off, your future self is begging you to start investing now. Tony Robbins, in his book Unshakable, lays out 4 brutally simple truths about investing that could completely change your financial future. Let's break them down. Let me tell you, the single most important rule of investing isn't about picking the next hot stock or timing the market perfectly. It's not about having insider information or predicting the next big market crash. It's about something much simpler, much more fundamental, starting early. The earlier you begin, the more time you give your investments to grow. You see, time is your greatest ally in the game of wealth building. It's the one resource you can't get back once it's gone. The earlier you start, the more time your money has to grow, to compound, to work its magic. This isn't just a cliche, it's a mathematical reality. We're talking about the incredible power of compound interest. Albert Einstein called it the 8th wonder of the world for a reason. It's like a snowball rolling down a hill, gathering more and more snow as it goes. The longer it rolls, the bigger it gets. The longer the hill, the bigger that snowball gets. And in the world of investing, the hill is time. Now you might be thinking, Tony, I'm not made of money. I can barely cover my bills, and I hear you. I can barely cover my bills, and I hear you. But here's the thing, you don't need a fortune to get started. Even small, consistent investments can grow significantly over time. Even if it's just $50 a month, the act of consistently investing, of putting that money to work, is what matters. It's about building a habit. Because it's not just about the money you invest today, it's about the habits you build, the mindset you cultivate. These habits will serve you for a lifetime. Imagine 2 people, both wanting to retire comfortably. One starts investing $100 a month at 20. One starts investing $100 a month at 20. The other waits until they're 30. The other waits until they're 30. That 10-year difference might not seem like much, but it's huge. By the time they both hit retirement, that early start can mean a difference of hundreds of thousands, even millions of dollars. That's the power of compounding. It's not about getting rich quick, it's about making consistent progress over the long haul. It's about making consistent progress over the long haul. It's about patience and persistence. So my friend, don't wait another day. Start investing now, even if it's just a small amount. Your future self will thank you for it. The journey of 1,000 miles begins with a single step. Take that step today. Listen up, because this is crucial. Most people obsess over how much money they can make in the market. They dream of hitting it big, of making a fortune overnight. But the real pros, the ones who build lasting wealth, they're obsessed with something else entirely, not losing money. They understand that the key to financial success isn't just about making gains, but about protecting what you already have. You see, it's not just about how much you gain, it's about how much you keep. Every dollar you save from being lost is a dollar that can continue to work for you. Warren Buffett, one of the greatest investors of all time, lives by 2 simple rules. Rules that have guided him through decades of market ups and downs. Rule number 1, never lose money. It's a straightforward principle, but incredibly powerful. Rule number 2, never forget rule number 1. This repetition underscores its importance. Why is this so important? Because losing money doesn't just set you back financially, it sets you back emotionally. The psychological impact of a financial loss can be devastating. It creates fear, doubt, and hesitation. These emotions can cloud your judgment and lead to poor decision-making. It makes you gun-shy, less likely to take calculated risks when the opportunities arise. This hesitation can cause you to miss out on potential gains. Think of it this way, if you invest $2,000 and lose half, you're not just down 50%. The road to recovery is steep. To get back to even, you need a 100% gain. That's twice as hard. This is why avoiding losses is so critical. That's why chasing risky investments, those get-rich-quick schemes, is a recipe for disaster. They promise high returns but come with equally high risks. Sure, you might get lucky once, maybe twice. But luck isn't a reliable strategy, but in the long run the odds are stacked against you. The market is unpredictable, and relying on luck can lead to significant losses. It's like playing roulette in Vegas. The house always wins eventually. The same goes for high-risk investments. Instead of chasing high-risk, low-probability bets, focus on preserving your capital. This means being cautious and making informed decisions. Look for investments that offer a margin of safety, that have a track record of steady growth. These are the investments that will help you build wealth over time. Remember, wealth building is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. Slow and steady wins the race. This age-old adage holds true in the world of investing. Protect your capital, avoid big losses, and let the power of compounding work its magic over time. This is the true path to financial success. Chapter 3. The Myth of High Risk, High Reward. Let's talk about a dangerous myth that's been sold to us for far too long. The idea that higher risk equals higher reward. Now don't get me wrong, there's a time and a place for calculated risk. But blindly chasing the highest possible return is a recipe for disaster. The truth is, the best investors, the ones who consistently come out on top, they don't look for high risk, high reward. They look for something else entirely. Low risk, high reward. Now Tony, you might be thinking, that sounds impossible. How can you have both? The answer lies in understanding value. True investors, they're not gamblers, they're detectives. They're constantly searching for undervalued assets, for opportunities where the market price doesn't reflect the true worth. This could be anything from stocks and real estate to businesses and even precious metals. The key is to find assets that are temporarily mispriced, that are trading below their intrinsic value. And you know when the best time to find these deals is? When everyone else is panicking, when fear is running rampant, when the market is crashing. That's when the real opportunities emerge, when you can buy a dollar for 50 cents. But protecting yourself isn't just about timing the market perfectly, it's about diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes, different industries, different geographical locations. Remember, diversification is your best defense against the unknown. It's about managing risk, not avoiding it altogether. Chapter 4, Net versus Gross Returns, the Fee Trap. Let's talk about a silent killer of wealth, a sneaky thief that robs you blind without you even realizing it: fees. These fees are often hidden in the fine print, making them easy to overlook but incredibly damaging over time. You see, it's not just about how much money you make, it's about how much you get to keep after all the expenses are paid. The difference between gross returns and net returns can be staggering, and fees play a huge role in this. And those expenses, those fees, they can add up faster than you think. Even a seemingly small fee can have a massive impact on your investment over time. We're talking about management fees, transaction costs, advisor commissions, the list goes on and on. Each of these fees chips away at your returns, leaving you with less money in your pocket. Now you might think, Tony, it's just a small percentage, what's the big deal? Well, let me break it down for you. Let me tell you, those small percentages over time, they can eat away at your returns like termites in a wooden house. Just as termites can cause significant damage over time, so can fees erode your investment returns. Let's look at an example. This will help illustrate just how impactful fees can be on your long-term investment growth. Imagine two investors, Mike and Kevin, both starting with $10,000. They both invest in the market, but with different fee structures. Mike invests in a mutual fund with a 3% annual fee. This might not seem like much, but let's see how it plays out. Kevin, on the other hand, chooses a low-cost index fund with a 0.5% fee. A much smaller fee, but does it make a difference? Fast forward 30 years, both experience the same market returns. They both ride the ups and downs of the market, but their end results are vastly different. But here's the kicker. Mike ends up with $76,000, while Kevin has $152,000. That's a huge difference, all because of the fees they paid. That's right, double the money, just by paying attention to fees. This example clearly shows the importance of understanding and minimizing fees in your investments. That's the power of compounding working in reverse. Instead of your money growing exponentially, fees are compounding against you, reducing your returns. Every dollar you pay in fees is a dollar that's not working for you, that's not growing exponentially over time. It's crucial to keep as much of your money invested as possible. So how do you avoid this fee trap? The answer lies in being proactive and informed about your investments. It's simple. Be an informed investor. Take the time to understand the fees associated with your investments and seek out lower-cost options. Ask questions, read the fine print, and don't be afraid to negotiate. Many fees are negotiable, and being informed gives you the power to make better decisions. Look for low-cost investment options like index funds, which have consistently outperformed most actively managed funds over the long run. These funds typically have lower fees and can provide better returns. Remember, every dollar you save in fees is a dollar that goes directly into your pocket, a dollar that can compound and grow over time. By being mindful of fees, you can significantly enhance your investment returns and secure a better financial future. So what now? Here's the brutal truth. Most people will nod along, agree with everything you just heard, and then do absolutely nothing. Don't be most people. These 4 rules: start early, protect your money, seek low-risk, high-reward opportunities, and watch out for fees, are what separate the wealthy from everyone else. Every day you delay is money stolen from your future self. Start now, even if it's just $50 a month. Years from now, your older self will either thank you or curse you for what you decide today.